isn't a new problem. It goes back to the earliest days of an international attempt to tax multinational companies. The very first big international report done for the League of Nations, the so-called Carroll Report, 1935, did look at a global apportionment approach or a unitary approach, and they concluded that it was politically impossible, that you couldn't get countries to agree on the criteria. But if you look at some of the detailed technical studies for that, for example the German one, they realised that that meant that they would be dealing with some quite important political issues on an ad hoc case-by-case basis, even if they tried this Alice in Wonderland approach. Really it would be a kind of a pretense. What they already identified in 1935 came much more to the fore in the post-Second World War period, when increasingly the issue not only of pricing transactions between related entities, but squirreling them away through artificial affiliates in havens came to the fore. And then you had, that was the origin, really, this highly complex international tax system that we've got, where you've got anti-haven rules such as CFC rules, and it was the US that led the way, first with its subpart F, which came into the OECD as CFC rules, then the US attempt to codify arm's length, which again came into the transfer pricing guidelines. Ironically then, the US itself started to identify in the 80s the limits and problems with that approach, but when the US tax reform amended the very long-standing US Section 482 to introduce a so-called commensurate with income standard, that created warfare in the OECD and resulted in the refinements that we've talked about, the TNMM and so on, where again the attempt is to maintain the pretense that we're dealing with independent enterprises, but really allowing a multiplicity of approaches. So the issue, as we've made very clear in the discussions today, I think, can we continue to pretend to fix this problem, or is there an alternative, and who should study the alternative? And fairly clearly, it seems to me that the United Nations Tax Committee should now seriously investigate the alternative. Unitary taxation, I would prefer to call it unitary taxation, i.e. taxing multinational enterprise or transaction corporations on a consolidated basis, a single unit, which would deal with not only the transfer pricing problem, but the related problems of artificial entities, so-called havens. Now that issue is now on the agenda, not only because for a long time it's been exercised in the United States on a state basis, but now Europe has had it on the agenda, and that's what I'm addressing today. Since 2001, the European Commission identified it as a policy issue, and in the 2000s has been working very steadily on it, issuing what they call a non-paper, setting up a working group which has very painstakingly gone through the technical aspects, with representatives of member states as experts, academic and business representatives, meeting over a three-year period, producing a communication and a working paper. But then obviously it was there. The technical stuff had been done, and it took the fiscal crisis in Europe to bring it to the fore with a political impetus about a year ago, a bit more than a year ago, with the so-called Franco-German Competitiveness Pact, which started to look at these issues of fiscal pact and asked for the Commission to bring forward a common assessment basis for corporate income tax. And the Commission had it in the bottom drawer and put it on the table. So it was put forward in March 2011, and very recently in April was approved by the European Parliament with some amendments. So what will be the next step in Europe for the CCTB? In principle, taxation is a member state issue, so it would need unanimous approval to be adopted as policy across the whole of the EU. Parliament, as I say, has amended the draft proposal from the Commission. The Commission isn't obliged, but could adopt any of that it wanted of Parliament's amendments. The moment it's being scrutinised for technical reasons, as I understand it, by the Council. But then the next political issue is, will it be put on the agenda for the Council? And if it is put on the agenda, clearly a number of member states are going to oppose it, not least the UK and the Netherlands, the clearer privileged tax areas such as Ireland. But on the whole, they're a minority of states, but still they form a blocking minority. So if, as would be very likely, you couldn't get unanimity for it, nevertheless that doesn't stop it in Europe. The Council could decide to proceed by what's called the Enhanced Cooperation Procedure, which in fact the European Parliament in its amendments said should be done. That would need, as I understand it, a new proposal from the Commission, but it only needs support from a minimum of 9 member states, provided the proposal is then left open to others to join if they wish. That would provide a further opportunity for consultation of the Parliament, and eventually could be adopted then by a significant grouping of European states. If adopted, that then legally takes the form of a directive in Europe, which has to be then implemented in the national laws of the member states. So it's transnational legislation, but still needs to be implemented in national law. There would obviously be a transition period, and it would be up to the Commission then to scrutinise the national laws to see if they're complying with the directives adequately. And the draft directive provides for review after 5 years. So that's where we stand on the proposal. Next is, what is the proposal? What's it about? The Commission's document makes clear it's, firstly, common rules for calculating the tax results of each company and branch. Now, it could only have been a CCTB, not a CCCTB. Simply common rules for calculating, but keep taxation still on a national basis. But this is common consolidated tax base, i.e. dealing with the problem of transfer pricing, as Kerry has already pointed out, by eliminating internal transactions, ignoring the false reality of hundreds, if not thousands, of artificial entities forming up multinational corporate groups. So consolidating the results for the members of a group, eliminating intra-group transactions, and then apportioning the consolidated tax base to the eligible member states, i.e. if it's not all the states, those that are joining in the system. So companies and groups opting in would apply a single set of tax rules across the whole of the EU, but they'd also deal with only one tax administration. It would be a one-stop shop. Companies which didn't qualify or chose not to opt in would remain subject to national corporate tax rules, including separate tax incentive schemes. Now, one issue with that is it could create, in one sense, competition between the CCTB and national rules. It provides a complete set of rules, and the Commission says, for company taxation, who can opt, how to calculate the base, the perimeter, i.e. what is a unitary business, anti-abuse rules as well, a system for apportionment, and a system for administration on a one-stop shop basis. Next, the scope of applications, eligibility. It applies to, or would apply to, companies tax resident in the EU, and also any EU-located branches, or in international tax jargon, permanent establishments of third country companies, provided there are companies of a type listed in the annex, which would be kept up to date by the Commission, or similar types of companies if they're in third countries, and if they're subject to a tax listed in the second annex, again, similar taxes in other countries. But that's a very broad scope of application. In the draft directive as proposed by the Commission, there's no size requirement or even cross-border trading requirement or anything. The Commission deals with that by saying it will be optional, up to the companies to decide whether to opt in. The Commission view is that it shouldn't force companies which are not planning to expand beyond national territory to bear the cost of a new tax system. However, that rather begs the question, why leave it up to the companies to decide? The impact assessment conducted by the Commission pointed out that if it were introduced on both a compulsory or an optional basis, overall it would result in slightly higher welfare. These are based on rather spurious, as usual, economic projections. I don't think personally they're worth very much, but I think the important point is a related point, that clearly there would be variations between different countries. The estimate made by one group of Dutch and British researchers is that countries such as Belgium, the welfare effects would be minus 4.5%, Spain plus, but there'd only be an overall gain if the rates were also harmonised. So I think these and others were reasons for the Parliament, by a strong majority, to say that it should be seen as compulsory to apply within 2 years to so-called European companies and cooperatives, and then to be made compulsory for qualifying companies within 5 years. optional only for small and medium enterprises, using an already existing definition in the EU of SMEs. But that will be subject to a review at the 5-year period. Now, under the Commission's current proposal, the opting in wouldn't be on a year-by-year basis, for example, being able to choose which arm's length principle you apply. It would be on the basis of a 5-year election initially and 3-year terms, giving notice at least 3 months before the first 5-year period, and notice of termination in the last 3 months of the term. The Commission puts forward the aims of the proposal as removing impediments on the single market. It provides this incentive, the multiplicity of tax systems, they say, provides this incentives for investment in the EU. It will be a growth-enhancing initiative, which is always good. We're looking for growth in Europe at the moment. The interaction of national tax systems leads to over or double taxation and heavy administrative burdens and high business compliance costs. It would resolve transfer pricing problems, yay! They point to the high cost of compliance using the arm's length approach, and interestingly the Commission's document says that for closely integrated groups, transaction pricing based on arm's length may no longer be the most appropriate method. So I think it's possibly the strongest statement by an international body yet that arm's length is broken. It doesn't talk very much about it being used as an anti-avoidance measure, particularly against havens, but I think that is really very much part of the proposal which should be strengthened where possible. Now, the issue of harmonisation of the tax base, the Commission wants to keep off the table. The Commission says it's only the computation of the tax base and not for tax rates. The Commission, and this is a political calculation really by the Commission. They really think that it would be difficult enough to get harmonisation of the base through without bringing in tax rates. So they argue that fair competition offers more transparency and allows member states to consider market competitiveness and budgetary needs. However, clearly from a political point of view, this could be problematic. Ireland is very much an issue there, obviously. And former President Sarkozy, again about a year ago, did refer to the unfair competition from Ireland in the context of saying, well, Ireland's asking us for a lot of money to bail out their banks, and yet they're undercutting us by offering this 12.5% tax rate. So the Commission, again, proposed more tentative, but saying that the Commission should consider moving to minimum rates the period of review after 5 years. The Commission puts the effects and benefits in terms of, for firms, I think probably the strongest is cross-border loss compensation. This is probably the most difficult thing to deal with through tax treaty systems. And they estimate the calculations based on the sample of multinationals shows about half of them, of the non-financials, 17% of the financials will benefit from immediate cross-border loss compensation. That just suggests to me that the non-financials are making much better use of tax havens to manage their own system of loss compensation or tax minimisation. I would guess that that means really that the medium-sized multinationals who can't afford the tax planning that enables them to get that would be able to get it without that kind of fiddling. Secondly, obviously, a reduction of compliance costs, and they estimate the reduction for recurring tax-related tasks in the range of 7%, but for opening a new subsidiary quite high at 60%, and offering tax-free intra-group reorganisation. So some benefits for business, significant. For member states, they say it's not intended to influence tax revenues, tax neutral, and that the impact on revenues would be hard to estimate, would depend on national policy choices and so on. They do provide a kind of get-out, a safeguard clause, if apportionment should produce an unfair result, and for the review after 5 years. A disadvantage with the optional system clearly is that it would mean that the tax authorities would have to administer two distinct tax schemes. But there would be fewer opportunities for tax planning, the way to that, and fewer disputes. And increasingly, the European Court of Justice has been quite active in striking down a lot of the measures that national states use, for example, CFC rules. Now, I think we need to put this in a wider perspective too. Firstly, on the European level, clearly the political impetus, a strong political impetus for CCTB is fiscal union. We've already talked about the financial transaction tax being pushed as part of the fiscal union issue. For my money, CCCTB should be there too, if anything stronger. There it is, it's a fully fledged proposal, it's been strongly supported by the Parliament, it's on the table. So a strong issue is, why apportion at all? Clearly apportionment would raise a lot of significant issues. Why apportion? Why not treat proceeds of corporate taxation as what they call EU-owned resources? Now, if the whole of the EU doesn't approve it, perhaps the Eurobloc could adopt it and treat it as own resources for the Financial Stability Fund and those kinds of expenditures to keep the euro on track. Secondly, for us all here, I think, the issue is, what about beyond the EU? Clearly, if a significant group of European states adopted the CCTB, this would be a game changer on the international level. I think immediately on the table should be, what about a link up with the US? The US already has long experience with the combined reporting on a state basis, so I think we need to investigate the compatibility of the European approach with the US combined reporting approach, and start shifting towards a new worldwide standard, which in my view would have very major benefits for underdeveloped countries, for developing countries, and I hope we can explore that a lot more. Thirdly, very importantly, I think we should foreground using the CCTB to combat tax havens and avoidance. At the moment, on the European basis, the group is defined to include qualifying subsidiaries tax resident in EU member states. But this leaves out, obviously, those who in many ways benefit from the existence of the EU, many of the dependencies. I'm thinking my own country of citizenship, the UK, Cayman Islands, Jersey, the Isle of Man, formally are not within the EU, but nevertheless benefit. They get, they're part of the internal market and so on. Extension to them and inclusion of entities resident in those jurisdictions would, I think, make a very significant difference, clearly. And in many ways, then, this would improve on the existing methods of combating havens, particularly through CFC rules. And the CFC rules themselves, I think, would be weakened by the competitive pressures, by leaving the CCTB optional for companies to decide. If companies could choose, then they might arbitrage between choosing whether they'd be better off with a consolidated basis or continue to use the opportunities of havens. Now, some say that a unitary approach would still allow profit shifting, that companies could relocate to take advantage of formula factors. But I want to come back to this in terms of the formula. Mark McIntyre said the unitary approach makes it clear that the allocation is political. I think he meant both technical and political. And if you look at the formula factors, they try to get away from the arbitrariness of the current allocations based on imaginary arm's length criteria by looking at real factors. They emphasize real activities and not paper activities. The rest of the slides, which will be up on the website, go through the details of the rules. And I'll try to analyse what's in there. Others can look at it too, and I welcome comments and support from others in analysing particularly the implications of many of the approaches in establishing the tax base, the timing and quantification arrangements, the approach to depreciation, valuation, losses, rules for entry and exit. Those seem to me to be pretty watertight. The system for consolidation of qualifying subsidiaries, the definition of a group, and the approach to consolidating all tax bases, the elimination of intra-group transaction. There are rules about changes in the group. Obviously, this would only apply on a European basis, so it's water's edge like the American state system. So it has to have effectively transfer pricing rules for the outside world, and also anti-abuse rules. It proposes a general anti-avoidance rule, and treatment of interest as non-deductible if paid to effectively tax haven subsidiaries with the definition there. It has CFC rules. The issue of apportionment I would like to dwell on here. The formula here is based on the US tripartite, 1/3, 1/3, 1/3. This is what the Commission put forward. However, with the significant difference that the labour factor is split in the Commission proposal 50% to headcount and 50% to payroll. The Parliament amended the tripartite by saying it should be only 10% to sales, 45% labour, 45% assets. Now, it provides for special rules for some types of institutions, so this addresses the issue of should there be special factors for financial institutions, their insurance undertakings separately again, oil and gas, and transport. Now, as I say, the calculation of the factors do seem to me to be important, especially this labour factor. So again, to stress, the Commission is proposing a 1/3, 1/3, 1/3, but with the labour factor allocated 50% to payroll, 50% to employees. Now, I think that's important where you're dealing with applying a unitary approach to countries where clearly there are differences in wage rates. Those exist in Europe. If unitary were to be projected on a worldwide basis, clearly the much greater inequalities in wages, in my view, would mean that a worldwide unitary would have to be based really on headcount without possibly including payroll at all. There are issues there also about defining who is an employee, who should be counted as an employee, and anti-avoidance rules there in terms of subcontracting and so on. And again, those need to be looked at in detail. The calculation of assets and sales factors are all there in detail and obviously need to be looked at in some detail. There are procedures for opting into the system, which again should be looked at. The system for administration, as I say, is based on a one-stop shop, based on filing with the competent authority. Now, again, this could lead to some arbitrage, possibly a taxpayer choosing a tax administration with a lax approach. But it doesn't lead to arbitrage on how much you actually pay, because the allocation formula deals with that. So that's based, as I say, on the principal taxpayer, principal tax authority approach. There's a system for coordination of implementation, which again I think is very important if we're to project the European level to a global basis. So with all that, thank you very much.